Today, let's talk about the world's largest utility, NextEra Energy. It's a company that's all about growth, including arguably the best record of dividend growth in the entire utility sector. 20 years ago, NextEra ranked 30th among utilities in global market cap. Today, it's number one, worth almost twice as much as its nearest competitors. NextEra's stock price has grown like crazy too, with a total return that has just about doubled the S&P 500 index over the last decade. And we can't talk about NextEra's growth without talking about the dividend. It's a dividend aristocrat, with more than 25 consecutive years raising its annual payout to shareholders, and it regularly increases its dividend by double-digit percentages. Hi everybody, Mike Nadell here for the Dividends and Income channel. Before I talk more about this high-quality business, please do us a favor to help grow our channel, okay? Hit the thumbs up at the bottom of the video, subscribe to our channel, and ring that bell so you get notifications of new videos as we publish them. Okay, now let's talk about NextEra's history, its business model, why we recently added to the NextEra position in our income builder portfolio, and how it might appeal to long-term dividend growth investors. The company came into existence on December 28, 1925, under the name Florida Power and Light. In its first year, FPL served about 76,000 customers in 58 communities. Back then, it owned power plants, water facilities, gas plants, ice companies, laundry services, and even an ice cream business. By the end of World War II, about a quarter of the FPL workforce had entered the armed forces. That led to many women being hired to perform jobs previously only considered, quote, men's work, such as truck driving, plant operations, and mechanical work. In 1950, FPL stock was listed on the New York Stock Exchange for the first time. As Florida grew, so did FPL's business. In 1966, the company serviced its 1 millionth customer. Florida Power and Light supported NASA's Apollo 11 mission in 1969 by building its Cape Canaveral plant and strengthening the area's energy infrastructure. In 1972, FPL began operating Florida's first nuclear reactor as the Turkey Point facility started generating electric energy. In 1985, Florida Power and Light achieved the ability to service its customer base without burning oil. It met demand by relying on its 4 nuclear units, natural gas, and coal-fired power from Georgia. In 1992, FPL reported that its power plant emissions were 70% lower than the national average for all utilities. In 1997, the company established an alternative energy division it called FPL Energy. A decade later, the division's name would be changed to NextEra Energy Resources, emphasizing the company's growing role in the energy sector outside of Florida. The company's first wind site, the Van Cycle Ridge Wind Farm, came online in Oregon in 1998. In 2005, FPL acquired Texas electricity provider Gexa Corporation. FPL became America's largest producer of wind and solar power in 2009. A year later, FPL Group changed its name to NextEra Energy, reflecting the company's commitment to the environment and its expansion outside of Florida. On the New York Stock Exchange, the company adopted the symbol NEE. In 2011, the Martin Next Generation Solar Energy Center was brought online. It was the first in the world to combine a solar thermal field with a natural gas power plant. In 2013, NextEra completed a multi-billion-dollar expansion of its nuclear capabilities at the St. Lucie, Turkey Point, and Point Beach plants. In 2014, the company launched NextEra Energy Partners, a growth-oriented limited partnership to acquire, manage, and own clean energy projects with stable, long-term cash flows. Its stock trades under the symbol NEP. In 2017, NextEra teamed with Sonoma Clean Power to launch the Golden Hills North Wind Energy Center in California, replacing old energy infrastructure with efficient, state-of-the-art turbines. In 2018, NextEra Energy bought Gulf Power from Southern Company. It also bought Florida City Gas that year. With those acquisitions, NextEra had firm control over Florida's electric power distribution, from the Panhandle in the Northwest to Miami in the far Southeast. Today, NextEra Energy Resources is the North American leader in clean energy, providing electricity by wind, solar, nuclear, and natural gas power across the United States and into Canada. 2021 was another outstanding financial year for NextEra Energy, capping a decade that saw earnings grow by an average of 9% annually, the best growth of any large American power company. And the growth is expected to continue for the foreseeable future. During its last earnings call on January 25th, NextEra raised guidance for the next 2 years, and they predicted average annual earnings growth of 6 to 8% through 2025. The market usually loves lofty projections of growth. This time, though, NextEra's stock was punished, losing 11.3% over the next 2 sessions. What happened? Well, it was announced that Jim Robo, the CEO who did a fantastic job stewarding NextEra Energy's progression into a renewable energy giant, was stepping down. He's being replaced on March 1st by John Ketchum, a longtime company executive who most recently has been leading the Energy Resources Division. It's not all that unusual for the market to be spooked when a successful CEO such as Robo leaves a company. But Credit Suisse remains very high on NextEra, saying, "We expect a quick but seamless CEO transition, with succession planning in place for years before the announcement. Incoming CEO John Ketchum is well regarded by investors, thanks to his deep expertise across the entire NEE portfolio. We see the new management team in place with 15 to 20 years of experience at NextEra translating to the same story. Execution at the high end of the long-term plan. We think the recent move in NEE stock is overdone, and we reiterate our outperform rating on shares." I agree with Credit Suisse that the pullback has been overdone, and I decided to add some more NextEra stock to my personal portfolio, with 3 buys in the last week of January at between $70 and $75 a share. I also selected NextEra Energy as one of the February buys for the Income Builder portfolio, a real money public project I manage for this channel's owners. We added 7 shares to our position at $75.75 apiece. I like that NextEra's main electric operations in Florida are overseen by state utility regulators who are considered friendly, meaning they're more likely to approve requests for rates that will help a utility prosper so it can provide the best service for its customers. I also like that NextEra scores so well when it comes to quality. Morningstar gives management its top grade for capital allocation and its second highest moat rating. NextEra also gets a solid A- credit rating from Standard & Poor's. High marks from Valuation for financial strength and relative safety, and a near-perfect dividend safety score from Simply Safe Dividends. And speaking of the dividend, few companies and no other utility can match NextEra's record of recent dividend growth. Over the last 15 years, the company has grown its payout by about 10% annually, and it has promised more double-digit raises in the future. Even with all that growth, the stock's incredible price appreciation has kept the yield down around the 2% mark. I know that might be a little low for some dividend growth investors, but I have no problem including such a high-quality company in my DGI portfolio. I've got plenty of utilities and other companies that take care of my higher yield needs. Now let's talk about valuation, or about how buyable NextEra is today. Analysts are mostly bullish about the stock, with 17 of the 23 monitored by Refinitiv calling NextEra a strong buy or buy. 10 of the 13 analysts monitored by TipRanks call NextEra a buy, with an average 12-month target price that suggests about a 25% upside. The stock's 27 forward PE ratio is pretty high for a utility, but NextEra is one of those high-quality companies that almost always trades at a premium. Morningstar actually says NextEra is fairly valued, trading close to its $78 fair value estimate. Value Line says NextEra has 20% upside over the next 18 months and could move 33% higher over the next 3 to 5 years. CFRA calls NextEra a buy with a $90 target price. NextEra certainly has performed great for the Income Builder portfolio since we first bought it in March 2018. Its 78% total return ranks 6th among the IBP's 46 positions, and it's also beaten the 68% return of the S&P 500 index over that span. For more information about the Income Builder portfolio, check out the link in the description. Once on our Dividends and Income website, become a subscriber. You'll be notified whenever I write an article about my buys and sells. Alright guys, that's it for today. Again, please give us a thumbs up, subscribe, and ring that notification bell so you don't miss out on any of our content. Take it easy everybody. Back at you soon.